Okay, so let's get down to today's session. So we'll look at the beginning part of our bond valuation. Our bond valuation. So it's a continuation from bond markets. So now we know that bonds are essential in any market, right? What is a bond by definition? A bond is simply a long-term debt instrument that's used to finance either a corporation or a government. So now, bond represents long-term borrowing instruments issued by either governments or corporations as well, raising capital. Over time, the value of these bonds tend to fluctuate. And these fluctuations are influenced by things like the interest rates, the inflation, the risk levels, and other macroeconomic changes. So because of this volatility, as a financial institution, you're required to continuously monitor the bond values to make better informed decisions. Now, let's get down to it. Okay, so now, this objective, we need to know how bonds priced and factors that affect bond prices. And then we're going to look at sensitivity of bonds later on. So let's get to the bond valuation process. So bond valuation is similar to the valuation of capital budgeting projects, right? Because in bond valuation, you're using the same principle as that the value of a financial asset lies in the present value of its future cash flows. So in terms of bond valuations, you're going to present value in all the coupon payments and the principal provided at maturity. So now we say present value of a bond is equal to the summation of your coupon over 1 plus your required rate of return for T plus the par value over 1 plus K the power T. So generally, this is your bond valuation formula here in this case. So you're going to discount in everything that's there. So because while we learn the principle that the value of an asset lies in the present value, the future cash flow. So in bond valuation, our basis is time value of money principles, because the value of the bond at the value of the bond is the present value of the future cash flows. Of course, we mentioned this already, that the investor is expected to receive. So they are now including the periodic coupon payment as well as the repayment of the par value at maturity. So C is the coupon payment, PV is the par value, K is the required rate of return here in this case. So this particular formula will mirror the valuation of capital budgeting projects and real estate, because in this one, I'm talking about present value of expected cash inflows in terms of capital budgeting. So here we have an example displayed for us here. It says, consider a bond has a par value of 1,000, which pays $100 at the end of each year in coupon payments, and has 3 years remaining until maturity. Assume prevailing annualized yield on the bond is similar, with similar characteristics is 12%. In this case, the appropriate price of the bond can be shown as follows. So now we are going to compute this and present value it all the way back to this particular time frame. So we're now saying the structure of the cash flows, right? We'll just draw this up here. This is year 0. In year 1, the coupon payment is 100. In year 2, another 100. In year 3, it's 100 plus the 1,000, because it's maturing in year 3 for 3 years maturity. This is year 3, this is year 2, this is year 1 here. So now we need to present value each of these figures up to our current data. So I'm going to say this is equal to the present value of the bond will be equal to 100 over 1 plus 0.12, because that's the rate of return, the power 1 plus 100 over 1.12, power 2 plus 100, 1,100, because I didn't both the 0, 1,100 over 1 plus 1.12, the power 3, which will give us how to obtain here. So we're going to have this as our final answer here, the 951.97. Any questions? Any questions?
No, it's okay.
Okay, so now, having looked at that, right? What is the impact of the discount rate on the bond valuation? What's the impact of the discount rate on the bond valuation? So now, when you look at the discount rate, it's crucial in the valuation of the bond, right? Because it reflects the investor's return demand based on the risk and opportunity cost. So a high discount rate reduces the value of the bond. A lower one increases. So we look at this graph here. It's played for us here, right? This shows the value of the bond here. And this is discount. So an increase in discount rate will lead to a reduction in the value of the bond. So say discount rate now, discount rate is inversely proportional to the value of the bond. So when you increase the discount rate, you're reducing the bond value. When you reduce your discount rate, you're increasing the bond value. Are we okay there?
Sorry, come again.
I'll say our discount rate is inversely proportional to the value of the bond. So now, an increase in discount rate will signify a reduction in the value of the bond, whereas a decrease in discount rate will signify an increment in value of the bond. So you can see from this graph here, it shows an inverse relationship between the value of the bond and the discount rate. So at the highest discount rate, the value of the bond is the lowest. At the lowest discount rate, value of the bond is the highest. Are we okay there? Are we okay now?
Clear.
Okay.
Yes.
So the key takeaway here is that the higher the rate, the lower the present value of the future cash flows. Higher the rate, the lower the present value of the future cash flows. That's the key takeaway here from this part. So now, apart from just this, we also have what you would now call this activity that's here. I see this activity here. Let's address this activity together. Why should one closely monitor the values of the bond? Why should you monitor the values of the bond? What you just covered right now. Why should you monitor the value of the bond? How do you address that question there?
Maybe to ascertain if it's still making a profit.
Yes. Yes, that's a good approach. Yes. Because remember, bond values are affected by the market condition, right? So us knowing the value, why us monitoring the value of the bonds will help us know or detect the interest rate movements. Interest rate movements. Also help us know our investment performance and strategy, as well as we're able to conduct our risk management and regulatory compliance. Are we okay there? Are we okay?
Yes. Yeah.
Okay. So question 2 says, when should investors use higher discount rates? When should investors use higher discount rates? So as an investor, you only use high discount rates where the bond is riskier, when there's an increment in opportunity cost. So the discount rate will reflect the required rate of return, given the perceived risk, right? And the alternatives. So use a high discount rate when you have a higher credit risk. So if your issuer's ability to pay is uncertain, let's say there's financial distress or there's potential of a recession. As an investor, you demand high returns, so use high discount rates to value the bond. Secondly, use it when there's a rise in market interest rate. So when the benchmark interest rates increase, the new investments offer better returns. So the existing bonds become less attractive and less discounted at a higher rate. Thirdly, use it when you have a longer maturity period and also when you have economic or political instability. So in this scenario, we're able to use use our higher discount rate. Any questions? Any questions?
No.
Okay, lovely. So third question says, what is the relationship between magnitude risk and expected return? How are these related? So generally, take a dive into your risk and return principles. Discover that these have a positive and proportional relationship. So what does that mean? It means that the higher the magnitude, the size of the risk, the higher the expected return an investor demands. So why is that? Why is that the case? This is because you're looking at the risk return trade-off principle. So in the risk return trade-off principle, you assume that investors are generally risk averse. So they only accept a higher risk if they're offered a higher potential return as a way of compensating for this. Secondly, because of the risk premium. So risk premium simply looks at the extra return over the risk rate. That compensates for taking up additional risk. Then also because the types of risk that affect return. And now look at a real example. Let's look at the Zimbabwean government, right? A Zim government bond may offer 12%, while a UK government bond offers 4%. The Zim bond just reflects a higher country risk and inflation expectations, which require higher returns. Are we okay there? Are we okay? Okay, let's look at the impact of timing of payments on bond valuation. What does this mean in timing of payments? It just means that the segmentation of payments in bond valuation. Are they annually? Are they semi-annual? Are they quarterly, and so on and so forth? So, earlier cash flows are more valuable due to reinvestment opportunities. So, a bond that pays semi-annually is generally worth more than one that pays annually, even with the same coupon rate. Even with the same coupon rate. So, in reality, most bonds have semi-annual payments. So the present value of such is shown as follows here. Because now saying that the present value of a bond on a semi-annual basis, now changes up. Present value of a bond will now be equal to the summation of your coupon payments over 2 here, over 1 plus R over 2 to the power T times 2 plus the power value over 2 also over 1 plus R over 2 the power T times 2. This is how you compute the present value of a bond on a semi-annual basis. Any questions? Any questions? Okay. So here's an example again. It's the same example we had before on the present value of a bond, right? Now I say it's semi-annual payment. So I'm considering a bond with $1,000 par value at 10% coupon rate, which is $100 paid semi-annually. 3 years of maturity, assuming 12% required return. So present value will be computed as you can see this point here. So I'm saying, remember, the coupon payment is divided over 100, 10% of 1,100 over 2. So say 100 here divided by 2 will give us 50. So which is the one that we're having here throughout. So I'm saying 50 plus 50 plus 50 plus 50 until the very end, then the par value plus the 50. Now, why is the time the return changing here? We're saying return was R over 2. So 2 over 2 is 6%, which is 0.06. So that's our return there. And our years are changing now from 3 years to what? 6, because our time from 3 to 6 because of the T times 2, which is 3 by 2, which is now 6 in this case. So this will give us a value of what? 950.82. So if you compare this value to the one before on the annual discount model, I see 951 here, and then this one is giving us what? 950.82. So the relationship here is just that because of discounting factors here, it's close enough to same approach here. Because now looking at it in this of saying that semi-annual bonds will give a better yield in comparison to getting annual bonds. Any questions so far?
No, it's okay.
Okay, all right, lovely. So let's look at the part on the coupon rate. The relationship between the coupon rates, required return, and bond price. So how are coupon rates related to the bond price and the required market return? So now, there are about three key relationships in this case. So your coupon rate, CR, is less than your required return, RR. You get to obtain what is known as a discount bond. You get a discount bond. A discount bond is one where it's less than the par value. So in this case, one less than 1,000 in this case, which is 950 in our case. Now, when your coupon rate exceeds your required return, you get a premium bond. Premium bond, one that exceeds the 1,000 mark. Now, in the case where coupon rate is equal to required return, you get a par value bond. You get a par value bond. Because why is this the case? Because in that case, your price will be equal to your par value. So let's look at the examples that we have here. So now, consider a zero coupon bond with 3 years maturity. So a zero coupon bond will only look at the par value itself being discounted. That's it. So if you observe, because there's no coupon payment here, but there's a required return, you discover that you get a value of 693, which is less than the par value, which is what you call a discount bond. So it's a very low price of the bond. It's a very low price of the bond. Now, if this bond had coupon payments, they brought about a higher amount. And because of lack of coupon payments, discover that it's 693 only. Look at an example here. It says consider a bond similar par value and maturity that offers 13% coupon rate. Now, in the case where your par value and the maturity are the same, and your coupon, your return are the same, 13% equals 13%. Discover that you're going to obtain what? A face value bond, 1,000 exactly. So it's exactly equal to face value because the entire compensation is provided by the coupon payments. So this is called the par value bond. And next one now, where the coupon rate is higher than the required return, discover that you get a premium bond because the price of the bond exceeds the par value. So it's called a premium bond. So in summary, this is how these are related. If the coupon rate is below the required return, the bond is a discount bond. If the coupon rate equals required return, it's a face value bond. The bond exceeds required return, it's a premium bond. Any questions so far? Questions? Questions? Okay. With that in mind, I'll give you a task to look at. So we're going to peruse through just to gauge understanding of bond valuation and how the price of bonds move in relation to the interest rates. In our next session, we're going to cover the bond movements and the factors that affect the bond prices in relation to the risk-free rate and the risk premium. So I'll post the question in the group. This is the one displayed the activity 5.2. I'll post it in the group. Okay, so the question has been posted in the group. You can go through it just for perusal, and then you can send the answers in the same group, and I'll review them later on. Cover the remainder of this topic and finish it up in time. Any questions so far?
Okay.
Any questions? All right. We're now going to wrap up here. Just an introduction to bond valuation, just to get you to understand how bonds move and how the market relates to bonds. Thank you for your time. Have a good day.
All right. Thank you.